Federal Reserve's reverse repo facility may be completely drained within the next 6 months. As over the last 6 months, we've seen over $1 trillion get drained out of this account. And in recent weeks, that has accelerated. We may very well see this account be drained 6 months from now. But what does that mean? And more importantly, what might that mean for the markets? If you don't know who I am, my name is Joe Brown. I run Heresy Financial University, where I teach hundreds of active investors how to make more by losing less money investing. If you'd like to join for only $99 a month, link is in the description below. If you want to know how the markets will react to the reverse repo facility not being in use anymore, potentially inside of 6 months, you might be thinking that it makes sense to look at what the markets did prior to the reverse repo facility being used. Because for years prior to 2020, the reverse repo facility was not being used at all. But what most people are not aware of is that even after the money printing started in 2020, it still was not being used. In fact, it didn't start getting used until April of 2021. So what exactly was it that switched on a dime starting in April 2021 that caused this facility to start being used? Well, as we can see by this press release from the Federal Reserve, which was dated March 19th of 2021, the supplementary leverage ratio for bank holding companies that had been temporarily changed expired on March 31st. But that probably sounds like pure Greek, so let me explain very simply what that means. Starting in March of 2020, all the money printing started, right? If you remember, this is when the Federal Reserve's balance sheet blew up. They printed a bunch of money and loaned it to the United States government. But the way the dollars work in the banking system is that they have to go into a bank account. And so they went to the government started spending money, that went into somebody's bank account. And then those dollars were spent by the politician or the business or the person as a stimulus check. And that got spent into somebody else's bank account, maybe the bank account of the grocery store or wherever they spent that money. Those dollars just go into somebody else's bank account. So the banking system got a flood of new cash deposits. But what most people are not aware of is that a cash deposit is actually a liability for a bank. It's not an asset. And this is because the bank owes that dollar back to you. So if all they did was hold on to that dollar for you, that would cost you money to have them just hold on to that dollar. They have to keep the lights on. They have to pay for the real estate. They have to pay the salaries of everybody working at the bank. So just holding on to that dollar, they would be losing money and they owe it back to you. And so instead they have to do something to start making money with that dollar. And usually what they do is they buy an asset, or in other words, they loan that dollar many times to the United States government. Now they still owe that dollar back to you, so they still have that liability, but now they also have an offsetting asset that can pay for that liability. But after the money printing started in 2020, the banking system was flush with too many deposits. The Federal Reserve didn't want banks to have to worry about the ratio between their assets and their liabilities, and so they temporarily suspended what they called the supplementary leverage ratio. In March of 2020, they told all the banks, hey, we are temporarily suspending the supplementary leverage ratio, so you don't have to worry about that just for the next year. Now, at the time, as April 2021 got closer, banks were starting to freak out a little bit. They were saying, hey, Federal Reserve, you've got to extend this because we've got a ton of deposits. There's not enough collateral out there, enough assets for us to go get. And the Federal Reserve said, no, we are moving ahead as scheduled, and this temporary suspension will expire on schedule, April 2021. And you'll notice that was the exact month that money started to flow into the reverse repo facility. Essentially, the reverse repo facility is an account at the Fed that banks can go to. They can put their cash in, they can get the collateral that they need. This is a chart of the yield on a 6-month US government treasury. And as you can see, yields were pretty much near zero. And as of the end of March of 2021, yields bottomed out at 0.027%. There was demand for this short-term collateral, and it went out to the open market, and it couldn't get enough of it. Otherwise, it would be pushing rates negative, and nobody wants to buy negatively yielding debt. And so the money came into the reverse repo facility instead. But just allowing access to this facility soon turned out to not be enough. The Federal Reserve wanted more cash to go to the reverse repo facility to get its collateral instead of buying it from the open market and keeping short-term yields so suppressed. So starting in June of 2021, just a couple months later, the Federal Reserve began paying 0.05% in the reverse repo facility. So not only could banks give their cash and get the collateral they needed, but that cash earned a risk-free 0.05%. Straight from the Fed's money printer. This rate lasted through March of 2022. And over that same time period, we saw the money in the reverse repo facility go all the way from 438 billion up to a staggering 1.7 trillion. Essentially, the Fed just made this facility very attractive. If you have cash as a financial institution, you can put your cash in the reverse repo facility. We'll pay you 0.05% and you get the collateral on your books as well. For the next moment, I would like to share with you about a very important company who is sponsoring today's video, Monetary Metals. The reason why I think Monetary Metals is doing something revolutionary goes back to when FDR outlawed gold ownership with Executive Order 6102. What most don't know about this executive order is that it also outlawed the gold clause that was common in debt contracts that allowed people to get repaid in gold if they wanted. Fast forward to 1971, when Nixon took us off the gold standard for good, and there was no reason for that law to be in place anymore. And what even fewer people are aware of is that law was actually repealed, which meant that it became legal to denominate debt contracts in gold yet again. Now, for the longest time, I was not aware that this was legalized in the United States, let alone that there was any company out there actually doing it. However, when I discovered Monetary Metals, I realized this is exactly what they are doing and nobody else is. They have created a way for you to start getting on your own personal gold standard by paying you a yield on your gold, denominated in gold, priced in gold, and paid in gold. They have multiple offerings like leases that pay between 2 and 5% and bonds that have paid up to 19%. Now, just to be clear, this means that if you have 100 ounces of gold at 4%, you would end the year with 104 ounces of gold. It is denominated and paid in gold. Regardless of the price of gold, regardless of what the dollar does, your gold is actually growing. Now, I have spent quite a bit of time over the last 2 years now researching how this company does what they do, getting to know the team. And as a result, I've become not only a customer myself, but I've actually also personally invested into the company. Monetary Metals is doing something truly unique, revolutionary, by paying you a yield on your gold, priced in gold, and paid in gold. And I highly recommend and encourage you to click on the link in the description below and get started by opening an account today. But then something unexpected happened. Inflation happened. This was something that many normal people who use reason and logic expected would happen if you print a few $1 trillion. But the brainiacs over at the Federal Reserve did not see this coming at all. And so when inflation came and then it stuck around, they freaked out and had to start raising interest rates extremely quickly. But there's a problem because of the reverse repo facility. The reverse repo facility at the time had over $1.5 trillion in it, which meant that if interest rates elsewhere became more attractive, all of that money would flow out and be extremely stimulative to the economy. And that was something they couldn't have during inflation. So every time the Fed raised the federal funds rate, they had to raise the rate that they were paying in the reverse repo facility by an equal amount, always keeping it 5 basis points higher than the bottom end of the federal funds rate. Essentially, raising the federal funds rate wouldn't do much if they didn't also raise the rate they were paying on the reverse repo facility. They had to do both in order to keep a floor underneath interest rates. And if you're trying to push interest rates up, it's that floor that you care about. And the Fed knew that money would only flow out of the reverse repo facility if interest rates elsewhere were attractive enough to make it worth it beyond the 5.3% they could now get in the reverse repo facility. Because any cash in the reverse repo facility is risk-free. You're getting that interest rate straight from the Fed's money printer. It's an overnight rate, which means there's no liquidity issues, no risk of default, just straight up access to the money printer. But now short-term rates are more attractive than what the Federal Reserve is paying in the reverse repo facility. The 6-month treasury at 5.55%. Additionally, T-bills of extremely short duration, you can get up to 5.5% on them as well. As a consequence, we've seen over $1 trillion leave the reverse repo facility in just the last 6 months. It topped out at $2.3 trillion in April and is now sitting at $1.2 trillion in October. We have 2 policies at work here. We have monetary policy and fiscal policy. Monetary policy refers to everything the central bank does. So interest rates, money printing, the Fed's balance sheet, quantitative easing, quantitative tightening, all of those things are the things the Federal Reserve does. That's monetary policy. Fiscal policy, on the other hand, is anything the government does. So when the government borrows money by issuing new treasuries, when they spend money on Medicare, Medicaid, Social Security, military spending, their discretionary budget, their mandatory budget, everything that they tax, the way they tax, who they tax, how much they tax, that's all fiscal policy. Right now, monetary policy and fiscal policy are butting heads. Monetary policy is making borrowing more expensive, harder. Monetary policy is sucking money out of circulation. This is a chart of the total money supply, and it has declined since May of 2022 as money has actually been destroyed. It ceases to exist. The money supply shrinks. That's monetary policy's doing. Fiscal policy, on the other hand, well, let's just say it's doing the exact opposite. The government's trying to borrow more, spend more, tax more. Essentially, it's trying to get more and more money in the headwinds of less and less money in circulation. And this is where the reverse repo facility comes in. There's about $1.2 trillion left in this facility. Hypothetically, if the government were to stop borrowing today, no further dollars would have any reason to leave this facility. They just stay in there and be happy to get paid their 5.3%. But every time the government borrows, especially at the short end of the curve, that's one more dollar that can earn 5.5% instead of 5.3%. And the issue is, once the reverse repo facility is empty, the government's going to need a new slush fund to borrow from, which begs the question, how much longer will this thing last? Well, in May of 2023, there was just under 2.3 trillion. Today, there's just under 1.3 trillion, which means in the span of 5 months, we've seen $1 trillion leave this facility. And the rate at which the money is leaving this facility is faster now than it was 5 months ago. That's because the rate at which government borrowing is happening is faster now than it was 5 months ago. Putting 2 and 2 together means that it's very likely we have just around 6 months left before every dollar has been drained out of the reverse repo facility. The government will have borrowed the full extent of all the money that was originally printed back starting in March of 2020. There will no longer be excess reserves in the banking system. It'll be used up. And for those of you who are paying attention at the time, the last time reserves got used up in the banking system was September of 2019, when the other repo market blew up. Now, there's 2 impacts that this has on the market. Number 1, it has an impact on the supply of dollars. Number 2, it has an impact on inflation. So first, let's look at its impact on dollars. This is measured by M2. This is the total money supply. And we can see that over the exact same time frame since the reverse repo facility has been draining since April of 2023, the money supply has been flat. Prior to that, from April of 2022 for the next year until April of 2023, the money supply was declining extremely quickly. But back to the reverse repo facility, as soon as money started leaving the reverse repo facility in April, the money supply stopped shrinking and has been moving sideways since. This makes sense because that cash that was outside of the banking system has re-entered the banking system through the federal government's borrowing. This is one of those really odd circumstances where normally higher rates would have downward pressure on the money supply and therefore on inflation. But in this case, higher interest rates pulled money into the banking system out of the reverse repo facility, thereby increasing the money supply, all else being equal. As we can see, it obviously stayed the same. Therefore, you didn't get the deflationary pressures from the monetary policy that you would have expected. This is one of the biggest things that I've missed over the last 6 months to a year, is not taking into account the money coming back out of the reverse repo facility and filtering back into the money supply. In my opinion, this is one of the largest reasons why we haven't seen a larger drop in the CPI over that same time frame like I originally thought we would. But it's important to note that the money supply has not increased. Again, we have fiscal policy taking this reverse repo facility money and reinserting it into the banking system, which is inflationary, but everything on the monetary policy side is deflationary. So we've had a net same amount of money in the money supply, which means no major change in inflation. And I would anticipate that to be the exact same moving forward as the rest of the $1.2 trillion left in the facility moves down to zero as the government borrows it and spends it, and it makes its way back into M2. I would anticipate the money supply to stay relatively flat over the next 6 months as this happens, just like it has for the last 6 months. And once that is done, once this $1.2 trillion has been used up, the impact on interest rates will be much, much higher. And in fact, we've already seen part of the yield curve uninvert now with the 20-year yield at 5.089%, while the 2-year is at 5.029%. We are seeing a re-steepening of the curve as fiscal policy is hell-bent on burying this nation in debt, while monetary policy is hell-bent on trying to stop inflation with the same thing, higher rates. As I've been saying for some time now, higher for longer. And of course, if you're not prepared to take advantage of this and profit massively off of these crazy moves that are happening in the markets as a result of these unprecedented times, you need to join Heresy Financial University, linked in the description below. As always, thanks so much for watching. Have a great day.